I just want to introduce myself to everybody. My name is Erica Dagnan-Minahan. I want to thank you for joining me for session 5 of Intro to Venture Investing. I am just going to pull up our chat window so that I can see your chat messages if anybody has them as we're going along. But I want to thank you so much for joining us today. Also apologize that we've got kind of a terrible lighting situation as all of our conference rooms were booked for the day. So I couldn't get access to one, which I usually enjoy having for the class. The other thing that I want to just let you guys know, I see that you've done a pretty good job with using the chat box to communicate with me, and there's also a Q&A box. Okay, great, I'm loud and clear, thank you. So I can see your questions and messages using that kind of off to the side. So please feel free to jump in at any point during the conversation with a question. And I'm happy to address it directly. So I see we've got Valerie here. I see we've got John here. I think we have another participant. So I want to thank you guys for joining today. So we're basically going to be picking up where we left off during session 4, which was, let's see, here we go. Basically, we had gone through this whole slide on the various rounds of investment that are made during the life of a company. And we're kind of ready to dive into the 7 key steps in the process of investment. So for those of you who are relatively new to early stage investing, a lot of people want to know, what exactly is the process that we go through and why does it take so long, right? So what are all the things that we need to cover, and, why does the process for a startup often take months, usually at least 6 months to go out and raise money, but a lot longer than people would expect. So for us here at 1000 Angels, we really have, what we would consider 7 key steps during the life of the investment. And it really starts off with screening our companies, right? So we're constantly going out there, participating in different workshops, webinars, courses, doing one-on-one advisory. I spend a huge amount of my time, going to demo days, going to conferences, speaking on panels, getting out there so that we can actually meet potential founders who are looking at investing in. And the process of meeting them, getting to know them, having them bring forth their business ideas culminates in what we call the screening process. So it's really just sort of deciding, okay, who's at the right point to actually go further into a conversation with and who is not at the right point. And, the whole screening process can be, incredibly interesting challenge of it seems like it doesn't really have a huge impact, but it's a huge part of this overall process. Because, for example, right before I started this live stream, I had a founder who had reached out to me about participating in a webinar course that I run, who had, 2 different business ideas that he was very early with. And he had sort of sent me a PDF and we had a conversation. It turned out, the course wasn't going to be a good fit for him financially, but he, wanted me to give him all his feedback on his other business ideas. And I have to do a lot of this kind of like at scale, right? So you've got this founder who's coming to you saying, hey, I'm working on these 2 ideas. Can you tell me where to go next with them? And it's incredibly labor intensive, right? To make sure that every single founder that you have an interaction with can come away with some sort of added value, but you clearly don't have the time to spend so much time with every single person who's not really at the right stage. So figuring out a screening process is really crucial to making sure that, 1, great opportunities don't get by you by accident, right? And number 2, that people who aren't quite ready also have to have a positive enough experience that, they're not going out there saying, oh, this person didn't pay attention to my wonderful baby that I'm trying to get funded, right? So learning how to get through, screening hundreds and thousands of potential opportunities in a year without hurting anybody's feelings, but without also letting great opportunities or what might be great opportunities in the future get by. really is an art. So once a company actually makes it through screening, and when we're screening, we're looking for a whole variety of kind of basic check marks that are required for us, to even consider evaluating a deal. And I think we'll go over some of that on the next slides. But then we get to the due diligence process, right? So due diligence is a much closer look, right? So it's sort of like, okay, we screened, everything kind of looks like it fits into our model on the surface. Due diligence is really digging in and, seeing what's really there, right? Sort of like turning over all the stones and making sure that, there's not something that might be amiss. I actually just had a situation with a company that we were considering for 1,000 Angels. That seemed like everything was really going well, but as we sort of dug a little bit deeper and into the person's background, there was what I would consider a little bit too much exaggeration of background, right? So had sort of made it seem like he had sort of had these jobs in finance at some top tier institutions that turned out to be small internships, some other things like affiliations with institutions that he wasn't really affiliated with. So for me, a big part of the diligence process is really getting to know how trustworthy this person is, and just absolutely listening to that own intuition to say, there's maybe a red flag here. So if during due diligence, clearly we want to be validating market size, going through the financial model, talking to customers, understanding a supply chain if there is one, understanding distribution channels. There are so many things, but for me, really the most important part of the due diligence process is really getting to know that founder and taking the time to understand, is this somebody that I can trust when things get difficult, right? Is this somebody that we can really trust with our money? And if you get any sort of an inkling that the answer is no, I would say that, that's always the time to get out of the deal. And, if either of you guys haven't already, I would definitely check out the Fyre Festival documentaries. My favorite one was the one on Netflix. It was very, very good. And then followed by the one on Hulu, which both really delve into an example of a situation where a founder was able to raise, I think he raised like close to $25 million total. And the entire thing was wasted in an insane boondoggle because I think people really didn't pay a lot of attention to the character of the founder. And for me personally, the money for Fyre was raised in like 2013. I had actually, been sent the deck and approached because I was managing a group of sort of professional athlete and influencer, celebrity investors at the time. And, as soon as I got the deck, I was like, this is the guy from that horrible Magnesis' company. Like, there's just no way, And so there were a million reasons why it immediately failed my screening test. But I think that, even without having to meet Billy, just sort of looking at the previous business and, sort of the way this is being marketed, with a lot of hubris, was for me an instant red flag to know that, this was something I should just, delete in the inbox and not really put more effort into. So, really trust your instinct on that, because the relationship is, only going to become more challenging over time. So you don't want one that starts off with you having any questions. Then we'll move on to actually structuring the deal, right? So if you are the lead investor, and with 1,000 Angels, we generally are not leading any of these investments. So the job of actually structuring the deal, negotiating the deal, would be up to the lead VC. And so, that is determining, okay, is this going to be a convertible note? Is this going to be a safe? Is this going to be a priced equity round? What are the valuations? What are, the other, what's the discount going to be? What's the interest rate? Sort of all of these, things that investors put in place to control the financial outcome. And, we'll be able to, in our advanced topics in startup investing webinars, dive in a little bit deeper into the different ways to kind of really sort of meet in the middle between investor and founder at that early stage, when sometimes the concept of what is this company really worth is a little bit uncertain. So all of these different instruments are so interesting and technical, because really what they're trying to do is create sort of a balance between the founder's very optimistic hopes for the future and protecting you as an investor who's probably trying to build a diversified portfolio and can't get over optimistic on any particular investment. So once the deal has been structured, basically a term sheet is offered to the founding team. If they agree to those terms, they're signed. The reason that we have a term sheet in the first place, for those who don't know, is that it's basically just like a plain English version of the documents that you end up getting at the end of the day. So I don't know if any of you guys are lawyers, but the actual legal documents for these investments, maybe excluding the SAFE, which was designed to be simple. A SAFE stands for Simple Agreement for Future Equity. When you're looking at the note purchase agreement and the subscription agreement and all these different agreements, it's almost like the lawyers are really trying to earn their money because they make it just as complicated as possible. So what the term sheet does is really just outline all of the terms in what most people would consider plain English. So it's a document that's very easy to read and agree upon between the investors and the founders. And then that term sheet is basically converted into the investment documents by the lawyers, which is going to, have a lot more wordiness and a lot less plain English in it. So once that's all been agreed upon, we get to the actual closing. So, everyone will execute their documents, sign their documents, wire their money, and the deal has been done. But after that, there are still, steps that we need to think about. So one is monitoring the investment. And really kind of understanding, what sort of monitoring you should expect post-investment, right? So, a lot of people who are, previous stock market investors, they're maybe used to like checking the value of their portfolio every day. You can't really do that with a startup investment. You have to realize that, number one, the founder is incredibly busy just, trying to do every single job that's out there. They don't have, a dedicated investor relations person. And what they'll typically do is give you about, they'll typically give you updates like about once a quarter. Some really on the ball founders might do updates once a month, but once a quarter to get, kind of a paragraph or two of an update is pretty typical. And then usually at year end, you're going to get a more fully baked update. I always give your founders at least 30 days, to actually get you the quarterly update, and probably like 60 days to actually get the year-end update together, because those things do take time. So that's one of the biggest, issues that I see with certain investors is, that they think once they make an investment in a startup, they kind of now, should just randomly be harassing the founder for updates all the time. And that's one of the worst things to do, to stress your founder out who's working really hard to provide a return on your investment, but to monitor it, right? So to know, okay, are they going to be raising a Series A soon? If they are, how can I help? What are they doing as far as, developing their sales pipeline? Is there something that I can do to be of assistance? And just sort of really understanding how the company is doing. Also understanding, if the company is possibly going to end up in a cash crunch, sort of becoming aware of it a little bit, on the earlier side, so that you can make a really thoughtful decision around whether or not you want to reinvest. And I think that, one of the biggest challenges that you might face as an angel investor, is how to make a decision if you've invested in a company that has done a seed round and the company's not sort of meeting the milestones that they need to get to a Series A. How do you make that decision as to whether or not you should participate in a bridge round, or sort of come in and make that decision between, am I sort of bailing these guys out because there's a real opportunity here, or am I just sort of throwing good money after bad in this instance? And that's something that we really help our members understand and work through. And of course, the end of the journey where we're all hoping to go is the exit. So companies can be thinking about exit the whole way along. What we sort of estimate as a investment horizon for this stage of investment is usually about 10 years. So we expect this entire process, unfortunately, to take between 7 and 10 years, but it really just depends on the company. So for example, I've invested in companies that had an exit within 12 months of investment, and that's wonderful. Like for example, with that company that we had that exited early, we doubled our money, right? But as you have learned in some previous webinars, as an early stage investor, you're actually hoping to make, say a 20 to 30x if you come in on a very early investment. And so that would be over the course of maybe the full 10 years. But if a company's exiting very early, you're probably going to be getting something lower than that, maybe like a 2-ish X or something like that. So, you can get out early, but you probably won't get the same multiple on capital that you had originally expected, or it can take a really long time and hopefully you'll get a very strong multiple on capital. So these are really kind of the 7 steps, and just to really kind of help you understand, that this is like a fluid process that we're kind of always doing and always at different stages with different companies. So, as I mentioned before, when we do sort of our first step of sourcing and screening, for us, it's going to events, constantly doing phone calls, member referrals, our relationships with accelerators and incubators, our relationships with seed and Series A stage VCs. We get tons of unsolicited applications just coming in through the website. I think I get about at least 600 a year, maybe a little bit more. And once we've kind of gone through all of this, very select number of people get kicked into the due diligence process. And whoever actually kind of comes out of that due diligence process actually gets featured as an investment opportunity. And, even for me, managing this whole process, I can't always guarantee, exactly who is going to make it through and who isn't, right? Because due diligence is real. We're not just kind of doing this as an exercise. Like, we're very seriously, making sure that there are no red flags in this business that could indicate, a potential loss of capital for our members. So when we take a look at the due diligence process, really understanding what is the purpose of due diligence and, what is it really based on, right? So what we're just trying to do here is really mitigate risk. And good risk mitigation is really what means the difference between a successful portfolio and a nightmare. And a big part of that is because, as you're building these investments, they take a lot of time. Some of them may grow slowly, some may grow very quickly, but what is really the most important thing is that none go to zero, right? So, I was putting together a returns analysis for the multiple on invested capital realized on our 2013 cohort of investments. So, over 2013, with the group that I was managing, we invested in 6 different companies. And so those companies are, one, as I mentioned, exited within 12 months. One, is up, I think, about 25x, so the one that's increased the most in value is up about 25x in, I guess it's been 5 years. The one that's increased the least in value is mark to market up about 1.5x. And the overall multiple return of the portfolio from that vintage year is currently about 8.5%, and it's about a 47% IRR, which is the target IRR, right? Now, the reason that this portfolio is doing really well is because, we didn't lose any companies. If out of that kind of half had gone to zero, that that would have a tremendously negative impact on the portfolio. So, for me, I think that one of the most important things about mitigating the risk is, to understand that it actually does really matter to vet all of these deals very, very carefully, so that you keep things that go to zero out of your portfolio, because there's a huge difference between, having a company that maybe hasn't done a ton of follow-on rounds, maybe hasn't increased 20-fold in value, but it's still up 2 or 3x, after a few years, will help the overall performance of your portfolio tremendously. So in order to avoid having those like go to zero scenarios, we really kind of look at all of these elements of risk. And so, there's business risk, right, which is, the stability of the market, their product, their financials, how they're marketing it, what's the cost of customer acquisition, what's customer lifetime value. And then there's people risk, which is an element of this whole thing that I think is where a lot of people go wrong, because this is really, really, really so important. The other stuff is fairly easily identifiable, but the people risk, the strength of the management team, the trustworthiness and credibility of management, I think you're going to see a lot of failures crater from this angle, from the people risk, and that's something that we spend a lot of time really thinking about. And then, of course, there's legal risk. So if the company is heavily based on some sort of intellectual property, then that's something to think about. We typically aren't looking at companies that are highly dependent on legal protections from intellectual property to drive our investment thesis. So a lot of what we're thinking about is, business risk, and a lot is about people risk as well. So those are kind of the fundamentals of our risk pillar. So during the diligence process, one of the things that's really important for us as a business is really to be very efficient with it, right? Oh, talk more about legal risk. Yeah, sure. So, Valerie, legal risk is completely, and so sorry, Valerie had just asked if I could talk a little bit more about legal risk. So legal risk is, really very, very case by case, right? So it just sort of depends on that company's situation. So for example, there are certain startups that, will come to you and say, oh, this is a great investment because we secured this patent and have this and that intellectual property. Sorry, I'm just looking at the rest of your question. Oops, locked. Why issue with highly dependent on IP? Oh, okay. So, it's completely case by case, but where you have to look at the most closely is if you're dealing with a company that is saying that a large part of its value is deriving from intellectual property, to actually really do an analysis of that, right? So, how well are they protected? For me personally, the reason I don't love to do investments that rely on intellectual property protections is because it costs a lot of money to actually enforce them. So, it's really case by case. But legal risk is something you should think about. Or, on the other hand, if you're dealing with a company that, potentially creates some sort of negative externality, you might want to think about legal risk. That's another thing that we are very careful to avoid is, dealing with investments in companies that create negative externalities that have potential legal risk as well. Okay, great. So in the process of due diligence, the most important thing is that we don't want to waste the company's time and we don't want to waste our time. So as soon as we see something that's like a glaring red flag, that's the appropriate time to kind of end the situation and get out of there. Secondly, we always want to focus on the biggest areas of concern first. I remember when I was just starting off in this business and I was executive director of a very large angel investor network, we were performing due diligence on a company it was called at the time Happy Baby. But the company, I think eventually it changed its name to Happy Family. And it was started by a woman that I had gone to Columbia Business School with. You know, we were both just like a year or maybe 2 years out of business school. And she had an idea for like a frozen baby food company, which was pretty cool. And so our group, you know, which was really managed by the members, diligence was managed by the members there, wanted to, you know, do diligence on the company. They thought it was an interesting idea. So they spent, I think, like a few weeks in pretty serious diligence with the founder. And then at the end, you know, kind of came to her and said, oh, well, we're not going to invest because we think that the market size is too little. Now, you know, she was, of course, quite annoyed. But at the end of the day, like, you can figure out what the size of the market is from the very beginning. So if that's one of your criteria, you know, it doesn't take you sort of 2 weeks, 3 weeks of the founder's time for you to determine that the market size for baby food is not large enough for you to want to invest in it. So really kind of understanding, okay, what are my big, you know, big picture boxes that I need to check, and let me check those off first. And if one of them doesn't really fit, then I don't need to, you know, take up 2 or 3 weeks of this founder's life when they need to go out and raise money from other people. And at the end of the day, you know, this founder actually ended up being very successful and sold her company to Nestle for like $300 million. So apparently the market was big enough. But, you know, point being here, you know, if you have, you know, certain things that are, really important, you know, you always want to make sure you get those out of the way first, the biggest areas of concerns, before you end up spending a lot of time with these people. Usually when I spend a lot of time in diligence with a founder and I end up passing, it's usually not because of some fundamental market or business opportunity, although something could be uncovered. It's usually because I get a feeling that the founder is not, you know, 100% honest, right? Like, I need to only invest in people that I know are 110% honest. And then, you know, communicating regularly with updates and really just very streamlined communication. So, you know, you want to be, or we really strive to be as clear as possible with founders as we can, and really take care of their time. So what are the materials that you need to begin diligence? And we would call our primary diligence materials the investor deck, the financial model, understanding the marketing plan, historical financials if the company's been in business, and the capitalization table. So these 5 things are like your must-haves before you start your initial diligence. And if a company doesn't have them, then, you know, I would say that they're not yet ready for funding. And I would say that, you know, a lot of people will get item number 1 and kind of call it a day. And that's very, very bad way of going into diligence. So you really need to look at all 5 of these. And why are they important? Well, number 1, everyone understands why they need the investor deck, right? That's not confusing. But the financial model, you know, I have seen so many companies that were huge failures that got funded. You know, take, for example, oh God, what was that company's name? I can't remember it now. It was like the one Jason Calacanis and Zirtual, right? So like Zirtual, for example, you know, managed to raise something like $5 million plus with no financial model, you know, and then when the company went bust, you know, kind of overnight, you know, the founder is sitting there being like, oh, it's not my fault because we never did a financial model. And it's like, well, that is your fault, but also it's the investor's fault, because what kind of investors are investing in your company without actually seeing a financial model to show how the business works? So for us, you know, that's really important. And if that's something they need to go back and create, they got to go back and create it. And we have to make sure that it's audited and that it works and that we understand the number side of the business really well and that the founder does as well. than, their marketing plan. So marketing plan can really be, depending on the business, like included in the financial model. An ideal financial model will also reflect what the marketing plan is, but making sure that we really kind of understand that, right? So how exactly are you going to sell your product? What are the channels? What are the costs of the different channels? What's your customer acquisition cost? How many people are out there that you can possibly bring on as customers? If the company has been in business, you definitely want to see historical financials. As you probably will notice if you watch or have watched that Fire Festival documentary, the founder was saying, oh, we made, so many hundreds of thousands of dollars in monthly revenue from their existing business. And they actually didn't. And certainly people could go in and forge things, but, it's much better to actually say, hey, let me see, the P&L from your QuickBooks or whatever it is that you're using to actually verify the historicals rather than just kind of like relying on something that they wrote in the deck. And then lastly, the capitalization table is really important to look at. So you need to understand, okay, who exactly owns what of this business, and you want to completely understand how has the company been funded to date. So you'll be able to see, okay, exactly how much they raised previously, exactly, how much equity the founders still own, what were the valuations of the previous round. So you want to make sure that you get all that information in diligence. And then some additional diligence items, which would be on a case-by-case basis, would of course be like their client list, their sales pipeline, any material contracts, reference checks on management, reference checks with customers, and in the case if the company did rely on intellectual property to support some of its valuation, really kind of digging into what IP they have. And then, of course, you have to complete your own independent research. So, first of all, really understanding, okay, what is their business model? And a business model is this company's system for creating and capturing value. So one of the big things that I see with startups and with investors is that, it's one thing to create value, right? Like you can say, oh, I made this really cool thing. And then people are like, oh my gosh, that's so cool. But what a business does is create the value, but also capture the value for investors. If there's no way for them to capture the value, like for example, if I started, I don't know, some sort of a content site, right? Where I'm writing really cool articles about a really cool topic that nobody else is covering, and I'm covering it better than ever before. But nobody really wants to pay for subscriptions, and it's impossible for me to get to enough scale to support myself with advertising. I don't actually have a way to capture that value. So even though I've technically created value, we'll never be able to capture it as a business. So it's not really a business. Maybe it's a nonprofit, maybe it's a hobby. So really understanding that difference is very key. So does it make sense? Can it make money? And also, is it scalable? So just because somebody's done something 1 or 2 times doesn't mean that they can do it 1 or 2 million times, right? So we need to think about what is really the scalability of this business for it to make sense for you as an investor to be an investable business. And then next is really understanding the market opportunity, right? So as the company made good assumptions about the opportunity, and when we say here, is it really $1 billion opportunity? It's because generally for a company to make for investors to consider business investable, the market opportunity should be around at least $1 billion. And the reason for that is simple. It might sound like, oh, that's egregious. Why does it need to be so big? Well, it's because, no matter what market you're going into, it's very difficult to capture 100% of the market, right? So let's say you were able to capture, 10% of a market, that would be amazing. So if your market opportunity is $1 billion, that would get you to about $100 million in annual revenue. And $100 million in annual revenue is typically kind of around where you need to be considered an attractive candidate for acquisition. So we just want to make sure, okay, can this company get to, at least $100 million in revenue in order for us to hopefully have an opportunity for exit. If the market opportunity is too small, what would happen is, the company would capture, a good chunk of its market, but it would never, get to a point where there was a possibility for you to exit as an investor, right? Because if the market opportunity is very small, acquirers are not particularly interested in it. They probably can't get large enough to IPO. So it ends up being a great business for, whoever's running it, but it doesn't end up being a great financial return for investors. So just something to think about as to why we need to make that decision. Next is, to really understand the customers. So how are they actually going to get customers? Most investors don't ever ask this question, right? So you have to really understand, what are the channels by which they're going to acquire their customers? What is the cost of customer acquisition? That's what we refer to as the CAC. And is the customer acquisition cost less than the customer lifetime value, right? So in addition to that, we also need to know, how long is the sales cycle, right? So how long does it take them from first having an interaction with a customer to actually converting that person into a paying client? These are all sort of things that we think about. Next, on the financials, really going through it with a fine-tooth comb. So does it make sense? Are the assumptions and outcomes reasonable? Is the plan scalable? So you'll actually be able to see all of this in numbers in the financial model. And this is something that you should not overlook, and you want to go through very closely. Most people are, Excel is not their favorite thing to do in the world. Luckily for me, auditing financial models is one of my favorite things to do in the world, hence why, I do this job. So really kind of looking through that and making sure that it makes sense is a key step in the diligence process. And then, of course, really understanding the competition. So, understanding the competitive landscape. It's like, yeah, you're making a great thing, but, is it 10 times better than, either the existing product or what your competitors are offering, right? Why are you going to be the one to win? This is such an interesting category when people were making all these meal kit investments, right? It's like, okay, these meal kits are great, but what's going to start a million other copycat meal kits, from coming into the market and basically driving the price, the profits down to basically zero, which is kind of what we've actually seen. I mean, it's such an interesting category, but that's one where the competitive dynamics really have completely eroded away any opportunity to capture value in that industry. And then, of course, are the management team. So we get to know them. We're doing reference checks. We're doing background checks. We're making sure they went to every school they said they went to, that they worked every place they said they went to, that they have the experience that they claim they have, that they're building the team that they say that they're building. So all of these things are really important aspects of the independent research. And so when we get to step 3, which is actually structuring the deal, what is most people consider to be the most important component of structuring the deal is determining the valuation. And this is the part that's really like the most fun, the most interesting aspect of putting a deal together is really understanding the art and the science of determining or evaluating a potential valuation for a company. So a few key tips here. Number one, it's always a negotiation, right? So it's not like, oh, this company is worth X, and that's like a hard and fast thing, right? It's sort of completely dependent on supply and demand, market dynamics, a lot of like touchy-feely things, the quality of the management team, how much capital there is chasing after, this category of assets, et cetera. So it's always going to be a negotiation, and there's kind of like a range, and, sort of seeing where you can fit into that range is really what we're going for here. As you're figuring out the valuation, looking at the existing cap table is really important, right? So how much equity is left over for current founders, as well as incentivization of the management team in the future, as well as, what were the valuation and structure of previous rounds, and what are the future capital needs of the business as well. So really kind of understanding that to help you estimate, where should this valuation fall. And with part of that, we actually use those figures in some, moderately complex calculators that we've created to help you adjust the current valuation for future capital requirements as well. So, just to kind of break it down into plain English, a company that needs $3 million now and $10 million in additional capital in order to, reach their final targeted $250 million valuation is worth way more than a company that needs $3 million now and $25 million down the road to reach its eventual $250 million valuation. So we have to take into account not only previous capital raised, current capital raised, but also future capital requirements of the business to help us come to what we think is appropriate for the current valuation. So if the company needs a lot more money down the road, that actually decreases today's valuation possibly, but a company that's very capital efficient, can create a lot of value with, can support a higher valuation. So, figuring out the right number, there are many different valuation methodologies that you can use. I kind of use what's called the VC method, which is sort of like backing into what you need your eventual return to be to settle on a valuation that makes sense today. And then also really thinking about meeting the entrepreneur's needs. I spend a lot of time with entrepreneurs helping them to understand the reality, which is that, from their perspective, they're kind of conditioned to think that like a higher valuation and more money is better, but that's actually not always what's best for their business. We spend a lot of time, or I spend a lot of time helping them understand, that what they're trying to do is provide a value evolution for their business, and actually overvaluing their business can be a lot more dangerous for them than actually undervaluing their business. So we'll get into some more of the details around why that is as we go further. So I'm just going to cut off here because we're approaching the 45-minute mark, and it looks like in our next session we'll be ready to dive into valuation methods and which types of evaluation methods are used by different investor types, and why they also depend on the stage of investment, as well as availability of cash flows. So I just want to thank everybody so much for joining in today. We are about to wrap. So if you guys have any last minute questions, you want to throw them into that chat box or the Q&A box, this would be the time to do it. Okay, are the past slides available for me to review? Yes, they are. So I actually have recordings of all the past sessions on our 1000 Angels YouTube channel. So if you go to that channel, you can definitely access the recordings and slides from all of the previous videos. It's 1000 Angels YouTube channel. And Valerie, if you want, I'll give you my email. If you want to email me directly, I would be happy to send you the link, and all of our recordings are posted there. Thank you, John. It was really nice to meet you, and definitely want to let everybody know that if you're interested in 1000 Angels membership, my email is Erica, ERICA, at 1000angels.com. I'm happy to set up a time for a one-on-one chat with you. And if you're ready to join, you can go to 1000angels.com and register for a 2-week free membership today. Also, like, share, and subscribe on YouTube. And we'd love for you to sign up for notifications for future webinars. So nice to chat with everybody. 1000angels.com. If you're an accredited investor, you can get a 2-week free trial membership today. All right, have a great day, and I'll see you at our next session.